Hello, this is a video to give an idea about repo rate and reverse repo rate. Just like CRR and SLR, these two rates are also tools used to control the supply of money in the economy and also to control inflation. They are a part of monetary policies of the Central Bank of India, which is RBI. Repo rate stands for repurchase rate, that is, the rate at which the banks borrow from RBI when they are in short of funds. The borrowing bank places approved government securities and borrows the required amount of funds under an agreement that the securities will be repurchased by the banks, the borrowing bank, after a specified period of time, usually 2 weeks. So that is repo rate, repurchase rate, which is the rate at which banks borrow from RBI. There's another rate called reverse repo rate, which is the opposite of repo rate. The reverse repo rate, which is the rate at which RBI accepts funds from banks. So the repo rate can be increased or decreased accordingly to take control of inflation. So when the rate at which banks can borrow from RBI is increased, that is, repo rate is increased, banks borrow less, and that will make the amount of money remaining with banks, that is, the funds remaining with banks to lend in the form of loan, decreases, thereby decreasing the supply of money and controlling inflation. And the reverse repo rate, that is, the rate at which RBI accepts deposits from banks. Banks start saving their funds with RBI and reducing lending for public, thereby reducing the supply of money. The banks start depositing their funds with RBI more because the interest, that is the reverse repo rate, will be higher. These two rates can be checked on the RBI website.